So what brings equity down is, there is one asset class which always brings equities down. That's what I'm going to speak. It's fixed income. So I've been given 20 minutes only to speak, so I'll keep it very simple. I'll not complicate things. So alternates, whenever we talk of equity, people talk of equity, then fixed income, and then what else? So somewhere down the line, we thought that alternates is also an asset class. Now what does alternates include? Alternates again includes equities, fixed income, private equities, office funds, which my colleague will speak. Now I'm not going to talk about 20% CAGR, 25% CAGR. I don't think we will ever be there in that. We'll talk of very simple stuffs. What is there in Earth? 10 to 12% or 13 or 14%. That's all we will talk of. That's all we can do. Beyond that, we leave it to the equity markets who will give you 100%, 1000%, 2000%, whatever the numbers are. Specifically, I'm going to talk of private credit. So what does private credit mean? And why do we need private credit? And what are the risks we see? Returns is something we will speak the last, but what is private credit? What exactly do we want to achieve through private credit? See, there are a lot of asset classes. Each one brings its own set of volatilities. Each one brings its own set of risk reward. So we have the real estate, the traditional land which we own. We have the traditional fixed income. We have the traditional FDs, savings accounts, and then we have equity and gold. Private credit exactly sits in the middle of this. So private credit, people should not assume that when we do a private credit, it means the returns are guaranteed and there's no risk. Credit always translates into credit risk. Whether we write the word risk or not, it's irrelevant. Credit always translates into risk. Now, what credit brings is a bit of stability in returns, a bit of stability in cash flows, a diversification, and one can also look at the investment horizon which makes. For example, in equity, when you put money today, will you know that you will make returns in 12 months? We don't know. Will you know that we will make returns in 2 years? Probably we don't know. 3 years, 5 years, 10 years, it's all, that timing is not in your hands. Whereas in a fixed income, in a credit, when you give money, when it's contracted, you expect the money to come back on time and without any delay or any default. Now, as I mentioned that, despite that, there can be a credit risk. And in our country, at least in India, I can tell you that the defaults have always happened in AAA papers. You can take all the names, anything which you recollect from 2018 to 2020, it has happened that way. So ratings don't dictate credit risk. The only thing which dictates credit risk is the underlying portfolio, where you give money, for what purpose you give money, and how do you expect to get the money back. And that's why credit is not exactly 2 to 6% product, nor it's an 18% plus product. But having said that, credit can encompass anything from 10% to 30%. Everything is credit. Now, what is that 10 to 12% is something we call as performing credit. You give money to companies or groups in which there is an underlying business which is reasonably doing well. You can give at 14 to 16% in which it's a special situation, a turnaround strategy. You can give at 18 to 20%, which is something very distressed fund. You can cross above 24% or 26%, which is venture debt. Everything is credit. Credit does not stop at, it doesn't start at 10 and doesn't end at 12. Neither does it start at 18 and ends at 30. So everything is credit, and anyone who reads the financial newspapers in India, every day there is a credit fund which is open. But that doesn't mean that all of us compete on the same risk. Put in a nutshell, what is the large cap expectations today you guys will have? 8 to 10%. Mid cap is 14, 16, small cap is 18. So why should a credit fund should have a different risk profile just because I am giving in the form of a fixed income? So risk is very important, but it brings certain advantages from a allocation perspective. I've seen till 2020, most people look at either debt and equity. What is debt? A straight mutual fund debt funds, a credit funds, or a direct investment, and then equity. Something which has evolved in the last 4 years, and that's where in global context, private credit is one of the largest asset classes. BlackRock, Blackstone, KKR, Apollo. You guys associate KKR and Apollo with what? Private equity? Whenever people talk of KKR or Apollo, what do you guys think of them? Private equity firms? But they're not actually private equity firms. You know what is the largest asset class? Private credit. Anyone has a chance to read through BlackRock's annual report, you should look at it. It's fantastic. BlackRock or Blackstone's. You should see where their focus is in. They run a $10 trillion, probably $11 trillion AUM today. You know where their focus is now? Private credit. And this is not their first attempt. But global private credit is very different to Indian private credit. One cannot associate global private credit with Indian private credit. But having said that, why do we need private credit in a country like India? So there are lots of capital providers in our country, starting with the biggest one, which is the banks. I know you guys are NRIs, so probably you may not associate this too much with me. But today, if one were to go and ask for a home loan in India and say that I have 100 rupees of cash in my bank account, can you give 100 rupees for my home loan? The bank will still say no. You know why? The bank will say I can give only 80. Why? It's a regulatory requirement, correct? So the remaining 20, who has to put up? The property owner, correct? So that's what we call as something which a bank would like to do but cannot do. It's what we call as what passes a bank's credit filter but not a regulatory filter. So not everything can be financed by a bank. You want to do an acquisition financing, a bank cannot do it. You want to do a buyout of a private equity, bank cannot do it. You want to give money for a equity purpose, a bank cannot finance it. You want to give money to smoothen your cash flows in a company, bank cannot do it. There is someone else who can do it, which is a non-bank financial institutions. But thanks to the equity markets, you guys don't value wholesale book, so they also don't do wholesale. They do a lot of retail. So that's a space which is vacated for someone else to do. Then there used to be the mutual funds. Between 2017 to 2020, the credit funds in the mutual fund category went up from 15,000 crore AUM to almost a 1 lakh crore AUM. You know what's the size of those credit funds today? It's back to 15,000 crores. Now, who fulfill this gap between 2020 to 2025? It's equity markets. There is a point of time. I mean, it kind of upended my learning of finance. The cost of equity was cheaper than the cost of debt. I have never seen it, at least in my 15 years of experience. But there is a point of time where raising equity is much easier than raising debt, and that happened. But in the last few quarters, again things are back to normal. I'm not saying again that equity markets don't provide capital. Someone has to provide capital. People always tell me that India is a service economy, you don't need capital. So then they ask what services India provides. They say airports, hospitality, healthcare. But then I ask them, how can you run a hospitality service or a healthcare service if you don't have a hotel or a hospital in place? It's a service only when you have an asset, right? Someone has to finance that asset. Asset has to be financed, any country. So there are restrictions in who can provide capital and who cannot provide capital. And that's why we need this private credit as a space. So we talked of why do we need private credit? What is private credit? And now what is happening is a lot of people used to make investments in, I would say, mutual funds, FDs, individual bonds. It's changing over the last few years. People want to look at alternate pooled vehicles to invest in certain kind of, I would say, fixed income nature. And that's where the Cat 2 funds have become a bit more active. but I would still pause here and say that we are still in the nascent stages. We are not very big. Private credit as a category in our country is very, very limited in scope, and there is a lot of runway to go. And I expect some accidents to happen on the way, but we will learn like every other time. This is a landscape of where do we fit in and what is the opportunity. Please don't get colored by the size of the opportunity. The size can be large, but not all capital will come from the investors. I expect most of this capital to come from institutions, because they can take those choices, they can make those investment calls, which probably an NRI investor or a corporate investor may not be able to make those calls. Few things which has aided in the credit space. The most important thing in the country which has happened is IBC and NCLT. So I used to work in L&T and IDFC. There were times when we used to give monies to groups like Bhushan, CG Power, and we never ever imagined that they will lose their companies, ever. You know, there is a simple statistic I will tell you. There were 36,000 companies which filed for insolvency code. Insolvency code. You know how many actually went through that process? 8,000 companies. 27,000 companies settled out of court. You know what that means? That means that today a promoter believes that if he does anything with a creditor, he will face the choice of losing the company. And that's a threat which was never there before 2015, 2016. Was never ever there. People tell me that, people always ask me a question in my fund, what is the security you take? What is the cover, security cover, the choice of words they use? I tell them that I'm not in the business of enforcing security. The reason being, if you are going to run a 4-year fund, and if I'm going to believe that I'm going to enforce my security and return the money back to my investors, probably I'm living in a fool's paradise. So what is very important is the threat of losing a company vis-a-vis dragging it through a court process. These are very two different exercises. So that's one of the most important events as a nation we have evolved, more than anything else. In a nutshell, there is demand, there is lack of supply, and that's why the private credit space fulfills in. It's a non-dilutive, to put it in very simplistic terms. It's not that simple, but I'll still make it very simplistic. It's a non-dilutive, customized and a flexible pool of capital. But it's a fixed income instrument, which means the money which is given needs to come back on time and without any challenges. I touched upon this topic at the beginning. Everything is private credit. Everything is private credit. This is one slide which we as an institution follow. What we would like to do, what we would not like to do. See, in this business, there's no stop loss. Unlike equity, there's no stop loss. If as an asset goes bad, that asset is gone. Yes, we might have security. We would like to recover the money, but it's a very long drawn process, and by the time the investors will get bored, and the time value money will erode all the returns, all the alpha which one can generate. So what's extremely critical in this business is, who do you lend money to? We call them as sponsors. Business calls one can take. People have gone through business cycles. One can never predict an event like COVID. But if you lend money to right sponsors, to the right promoters, to the right management, generally you will not have challenges in working out. Second, very important is you have to know how do you get your money back. Now there is a plan A and there is a plan B. Plan A always doesn't work. You need to have plan B in place. Now the plan B can be anything. But if one were to rely only on plan A, it doesn't work at all. You need to have plan B. What we wouldn't like generally as an institutions, we don't like asset light businesses. We don't like giving money to greenfield projects because we are raising a 3 to 4 year capital. I cannot expect give money to a project which is going to start now and expect to deliver after 4 years down the line, because inevitably projects always gets delayed. And we do not want to deal with business groups which has not a great track record dealing with stakeholders. So the risk we run in this pool of capital is, being a closed-ended fund, you don't run a liquid risk, you don't run a market risk, you don't run an interest rate risk, but you run a credit risk. And credit risk is absolutely paramount. Credit risk does not come with any stop loss. It just hits you straight away. The alpha which is worked hard to generate will be eroded in a single investment. So portfolio, selection of investments, and your plan B is extremely critical when we do credit. Any type of credit, be it a mutual fund, be it a Cat 2 fund, be it a venture debt fund, it's extremely critical. I think I'm done.
Thank you, Jagan, for
So